Welcome everyone to Vested Interest. This is Shane, and in this video, we are going to take a look at 4 stocks at or near 52-week lows. But before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. The channel continues to grow because of people like you. For those of you who may be stopping by for the first time, on this channel, we focus on dividend growth investing. It's not rocket science, in my opinion. The best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, buying dividend growth stocks and growing companies with a positive cash flow that covers the dividend and a high return on their invested capital. I utilize both a dollar cost average approach, consistently investing into my portfolio on a weekly basis. I do cover those weekly investments on my Sunday portfolio update videos. I also do larger purchases if I do a side job or get a bonus or run into any extra cash. That way, I cover all my investments into the portfolio on this channel. I do not have a paid Patreon account. I don't intend to have one. We all have enough to pay for, so it's free to see what I'm investing on. I don't send you into any other links or any other sites you've got to sign up for. I'm not asking you for your email or phone numbers or anything like that. It is free to see what I'm doing on this channel. But if you would like to help the channel, if you could do me a huge favor, hit that thumbs up button down below. Let me know that you like the videos. Make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. A lot of you watching the videos are not subscribed. Actually, the vast majority of you out there watching the videos are not subscribed. So make sure you click that subscribe button. Click that notification bell so you're notified whenever we put out any new content. Again, we do a portfolio update video every Sunday morning. We also do a stock pick of the day series Monday through Thursday where we take a look at an individual company stock that's pulled back on the day to see if it is presenting any value. I also do viewer and subscriber suggestions. So if you have a stock you'd like me to take a look at in one of those videos, go ahead and drop it down in the comment section below, and drop a comment down below. Let me know what you think of the video. Let me know what you think of these 4 companies. Are you buying any of them? Have you been watching them? Are they in your portfolio? Or are you possibly selling one of them, or 2 or 3 or 4, or all of them, or anything else in your portfolio? Really love to hear from you. Let me know what's going on in your portfolio and in your investing journey down below. Now that we're through all that, let's get back to the video here. Number 1 on our list that we are going to take a look at is Genuine Parts Company, ticker GPC. This is out of the industrial sector. They closed out the week, and all of the numbers we're going to look at as of the close of business on Friday. I know it says the 6th. That's whenever I pulled this data together. That was Friday afternoon. This video will come out on Saturday the 7th. So this information should be updated, at least the most up-to-date information as of the close of business on Friday. So again, close out the day or the week at $134.39. So they were slightly down 2.15%. As you can see here, 52-week range as low as $126.35, as high as $164.45. So they are not quite right at their 52-week low, but not very far off of it. Now they do have a beta of 0.91, so that means they're less volatile than the overall market, but not much less volatile than the overall market, one being the market. Analysts call it a consensus buy. They have a price target of $161.14, which presents potential 19.91% upside. This one has an EPS of $8.64 per share. Current price to earnings ratio is 15.55. Forward PE a little lower than that at $13.77 per share. Dividend is $4 annually. They are a quarterly payer. So divide by 4 there, that'd be $1 a share per quarter. We'll see that here in a little bit. And the dividend yield, nice starting dividend yield at 2.98% on this one. Ex-dividend date was September 6th. So we just passed that. So if you were to buy them next week, you would not be in line for this next dividend. Looks like it's going to pay out on October 1st. And let's jump over here to the right. We're going to take a look at dividend yield theory to see if this one is presenting any undervaluation, at least according to dividend yield theory. To do that, we look at their 5-year dividend yield average at 2.73%. We compare it to their current 2.98. They're calling it 2.91 over here. I pulled all this information from stockanalysis.com and finance.yahoo.com. So really yahoofinance.com is what it is. So there are a couple different sources where I pulled this information from. So go ahead and check out both of those sites. I'm not affiliated with either one. I always recommend more than one site to pull the information from. As you can see, they're not always exactly aligned. 2.98%. This was from stockanalysis.com. This over here on the right was from Yahoo Finance. They've got them at 2.91. But either way, you compare that to their 5-year average, 2.73, and since it is higher, currently at 2.9 or 2.98, It currently speaks to undervaluation according to dividend yield theory. Now, the payout ratio on this one is very low, 45.14%. So they have a lot of room to continue to raise the dividend, make acquisitions, pay down debt, buy back shares, do everything that companies do with free cash flow. This one is not in danger or even close to being in danger of a dividend cut. So I like a 75% or less payout ratio, unless it's something like a REIT or a limited partnership or something along those lines where they typically pay out more. So this one is definitely in that range, under 75%, even under 50%. So I really like that. Now, return on invested capital and return on equity are two metrics I look at to see how efficiently a company is reinvesting its capital back into itself. So I like 10% or better for both of these metrics. Return on equity, 28.06%. Very nice. Return on invested capital, 12.22%, just over the 10% I'm looking for there. Very good numbers overall. You can jump down here to free cash flow. I want growing free cash flow over time because typically if a company, especially a dividend paying company, has growing free cash flow, they raise their dividends along with it. And I want growing dividends. Hopefully you do too. Going back to 2021 here, you can see 992 million in free cash flow, 2022 up to 1.1 billion, 2023 922 million. So it looks like it dropped down a little bit in 2023, and so far in the trailing 12 months they're back up to 1 billion. We'll have to see how they shake out because this does include part of 2023 numbers here, right? We're only into September, so this is not all 2024. It does, trailing 12 months would include part of 2023 here, but it looks like they are continuing to repurchase shares as well. You can see here 2021 they repurchased 333 million, 222 million in 22, 23 up to 261 million, and again it looks like they're continuing that trend in 2024 so far. Now looking at Genuine Parts Company's revenue, you can see here a nice tick up over time, right, going back to 2019 to current. Looks like actually 2023 maybe they flattened off a little bit, the trailing 12 months as compared to 2023, but currently sitting at 23.16 billion in revenue, and again that has continued to grow. It looks like there was only really one downturn over the last 5 or 6 years, and that was in 2020 where they slipped a little bit. Overall, pretty consistent revenue growth. Like to see that. Profit margins here you can see 5.24%, which is pretty much in line with what their average is. I mean, I would look at these the trailing 12 months plus the last 3 or 4 years. The only one again that really has a down year would be 2020, which would line up with where their down year was in revenue. So that makes sense. EBITDA looks very much or very similar to their profit margin. Nice stair step up. Looks like it's kind of plateaued here. 2023 and 2024 might be very similar numbers. Which again, with oil prices, or I'm sorry, with the overall markets, this one is not an oil company. We do have several oil companies. With the overall market starting to cool a little bit, that makes sense if 2024 numbers are in line with 2023. Now here, total assets, I like to see growing assets over time, and same thing, short of 2020 here, they have nice stair step up when growing assets, currently at 18.87 billion. I like to compare that to liabilities. Their liabilities have grown over time, but they still have more assets than liabilities. If they had to sell off assets to cover liabilities, they could do that, and they would still come out the other end with a little over 4 billion in total assets left on the balance sheet. So I like to see that. Total debt has raised a little bit over the last couple of years. They are paying down debt over time, but they are also taking on a little bit of debt as well. I'd like to see this trend reverse and go back to what we saw in 2019, 2020, and 2021, where it was decreasing debt. But it looks like in the last couple of years they have taken on a little bit of additional debt. Not a ton, but that's something to keep an eye on, right? Now, shares outstanding, I like to see decreasing shares outstanding. As you can see, currently at 139.72 million, and they are slightly decreasing over year. It's not a huge drop every year, but they are pulling more shares out of the market. So I like to see that. Again, quarterly payer, 46.28% payout ratio, dividend yield of 5.47, or I'm sorry, dividend growth of 5.47%. So they are growing the dividend over time. 68 years of dividend payouts. Buyback yield of 1.07%, which tells you that when they are buying back shares, which we see they are, right? Shares outstanding is coming down. They are doing it in an efficient manner. Buying back shares with a positive buyback yield. Shareholder yield of 4.05%. And again, $1 per share is their dividend payout currently as of September 6th. and that's going to be the October 1 payout. So that is Genuine Parts Company, again, out of the industrial sector, and they sell parts, automotive parts. That's their bread and butter. That's what they do. Go ahead and check that company out if you're interested. It is not in my portfolio, but it is one on my watch list. It is one I have thought about adding to the portfolio. I think the company overall is very strong. I do like the numbers. I would like a little bit more dividend growth, but this is a pretty well built out company with a payout ratio so low. I'd like to see a little bit faster dividend growth, but that is not bad. You know, mid single digit dividend growth is pretty good. That's number one. Number two on our list is Warren Buffett approved. Now he has added a significant amount. We'll see one other company, Chevron, here in a little bit. Also one that Warren Buffett has recently added to his portfolio and been buying over the last several years. I think actually he may have in his most recent 13F actually sold a little bit of Chevron, but he is continuing to add Occidental Petroleum Corporation, ticker OXY. This is out of the energy sector. Closed out the week at $52.04, down 3.16% on the day on Friday. You can see your 52-week low as $51.79, as high as $71.19. And this one is one that is impacted by oil prices. Oil prices have been pulling back, so I'm not surprised to see that this one has pulled back itself along with oil prices. And if oil prices continue to pull back, this one, along with Chevron that we'll look at here in a little bit, will continue to pull back or could pull back potentially because, again, they are impacted by oil prices. Beta of 1.60, so unlike Genuine Parts Company, this one is more volatile than the overall market, and it is significantly more volatile. So you may be able to use that volatility to your advantage. Whenever you see volatile companies like this, that means they have wild swings up and down, more so than the market, and you could take advantage of that and catch the buying opportunities on those down swings and then be holding through the upswings. Analysts call it a consensus buy. Price target of $71.36 per share, which presents a potential 37.15% according to them. As you can see here, EPS sitting at $4.06. PE ratio sitting at $12.82 with a forward PE a little lower than that at $11.99. Dividend is 88 cents per share. This is another quarterly payer. We'll see how that shakes out per share price there currently in the next slide. Nice, a little lower dividend yield at 1.69%, but we'll see how fast they're growing that dividend over time. Maybe even though it's a lower dividend yield starting out, maybe over time we get good growth on this one. We'll see. September 10th will be the ex-dividend date. So you need to buy them on the 9th. So I think that would be Tuesday or before, Monday or Tuesday, to be able to get this payout on the October 15th. Jumping over here, looking at dividend yield theory again, 5-year dividend yield average of 4.15%. We compare it to their current 1.64%. Since it is lower, that speaks to overvaluation on this one. Now, I will point out that Oxy, I think it was 4 or 5 years ago, cut their dividend. So part of this reason that this dividend yield is so high as compared to their current is because of that dividend yield, dividend cut. Again, I think it was 4, maybe 5 years ago they cut the dividend. So I don't know that dividend yield on this one because of the dividend cut really is applicable, but according to dividend yield, this one is potentially overvalued. Now with that cut, that really decreased their payout ratio down to 20.73%. They've also started paying down debt significantly. We'll see that here in a little bit, hopefully. It's reflected in their balance sheet. So very low payout ratio. So even though they cut the dividend recently, if they start that dividend raises again, maybe the starting dividend yield makes sense and we get some aggressive dividend raises. And it's okay. It does happen. Companies cut their dividend from time to time. And sometimes if they're doing it for the right reason, paying down debt, making the balance sheet a little more attractive, that sort of thing, it makes sense. But if they're just doing it to cut the dividend, to put more money in their pocket so they can pay out executives or something like that, then I don't like it. I don't like to see dividend cuts at all, but sometimes it does make sense for a company, with a lot of debt or a very high payout ratio to cut that dividend yield and get their balance sheet a little bit. And again, if they're using those funds that they're going to save from the dividend cut to pay down debt, to buy back shares or something along those lines, then, or make acquisitions, reinvest back in the company, then maybe it makes sense. You just don't want, like I said, want them to see them cut a dividend and they're, paying a big lawsuit out or something like that, which is another reason 3M, for example, I think recently cut their dividend, but part of that reason was because they were paying a big lawsuit. You don't want to see that because that means their free cash flow is going to other avenues you don't want it to go to. But low payout ratio currently, partly because of that dividend cut. Return on equity and return on invested capital, again, I like 10% or better. Return on equity beats that metric at 14.43%. Return on invested capital a little low at 6.49%. Like to see that come up a little bit. Dropping down to free cash flow, you can see here 2021, $7.6 billion in free cash flow. 2022, $12.4 billion. 2023, big drop down to $6 billion. Trailing 12 months so far, $4 billion. Looks like it might be in line with what we're seeing in 2023, if not a little bit lower. They are repurchasing their shares. Like to see that. 2021 was $8 million in repurchases. 2022, $3 billion, very aggressive. 2023, same thing, 3.4. Trailing 12 months looks like they're continuing that trend, not quite as aggressively at 1.3 billion, but we'll see how the rest of the year shakes out. So again, it looks like part of that dividend cut, they've reallocated some of those funds to buying back shares. Now jumping over to their revenue, again, very nice revenue growth up to about 2022. Looks like actually in 2023, a slight downtick. Looks like 2024 might be very comparable to 2023, at least according to the trailing 12 months so far. I would like to see that continuing trend of revenue growing, like to see this reverse trend and start going back up. But again, 2024 being very similar to 2023. It's not a huge drop and still above what we saw in 2021. 2022 just looks like it was a very good year. So overall, revenue looks steady. Profit margin also looks pretty steady. Again, you had the 1 year in 2022 where they outperformed, but overall, they're right around that 14.28% they currently sit at. Only 2020 where they had the one down year. Right, so that makes sense. EBITDA very similar to what we're seeing with profit margin, right? 2022 being the 1 year that stands out. The rest of them are pretty steady. 12.23 billion. Total assets, you can see here, there was a decrease in total assets from 2019 to 2022. Looks like 2022 was the bottom, and they're starting to turn that around. 2023 and 2024 currently sitting at 76.228 billion. Comparing that to total liabilities, 43.96 billion. So again, if they were to have to sell off assets to cover liabilities, they could more than cover those liabilities and still come out the other end with a positive balance sheet, right? Positive assets on their balance sheet and pay off all their liabilities. Which you don't want a company to do that, but you want them to have the ability to do that. This means they could go to the bank and say, hey, if we've got outstanding debt we need to cover, we've got more assets to utilize as leverage to cover some of those liabilities and that debt. We'll look at here in a minute. Shares outstanding, same thing. They are pulling shares out of the market. I like to see that, right? Currently 886 million. Looks like from about 2022 on, they've been pulling shares out of the market. Total debt, they do have debt decreasing. Again, that's part of the reason they cut that dividend here 4 or 5 years ago. So I like to see that debt coming down. I like to see those shares coming out of the system. I like that their assets outweigh their liabilities. They are a quarterly payer, very low payout ratio, 21.68%, partly because of that dividend cut. Now here's where they're making up for some of that. I like that they're making up for some of that dividend cut with very fast dividend growth now, 25.37%. 2 years of dividend growth, so it looks like that dividend cut was about 3 years, not 4 or 5 years ago. Buyback yield 2.82%. They're doing that efficiently. Shareholder yield of 4.51%, and their current payout per share is 22 cents. Again, going to pay out on October 15th. You need to buy the September 9th or before to get that next payout. So that is Occidental. Again, this one is in Warren Buffett's portfolio. He has been buying this pretty aggressively over the last 2 to 3 years. Atcor, this is another one I recently did a stock pick of the day video on. This is Atcor Inc., ticker ATKR. This is also out of the industrial sector. Closed out the week at $83.77. 52-week range as low as $83.31, as high as $194.98, right up against their 52-week low here. A beta of 2.14. This is twice as volatile, a little over, twice as volatile as the overall market. A lot of volatility with this company. So again, with these companies that are very volatile, you might be able to use that to your advantage. Take advantage of those downswings and then hold on the upswings on companies like this. That's how I play them. Analysts do call this a consensus buy. Price target of $137 presents a potential 63.54% upside on this one. Ex-dividend date, August 20th. They did pay out on August 30th. So if you were to buy them now, you would then be in line for the next dividend. You're just going to have to wait a few months to get it. You can see here EPS sitting at $14.24 per share. Very low PE ratio on this one, currently at 5.88%. One of the few out of the four we're looking at today with a forward PE higher than the current 7.29%. So again, they see it turning around. That tells me they see this one turning around and the price per share starting to rebound with a higher forward PE than where it currently sits. Dividend $1.28 per share, another quarterly payer. We'll see that here in a little bit. Lower dividend yield. This is the lowest, I believe, of the four, 1.53%. We'll have to see how fast they're growing that dividend. Jumping over here, we're going to take a look at dividend yield theory. Unfortunately, this one here does not really qualify. It does not have 5 years of dividend payouts. I believe they have only been paying out 1 or 2 years, I believe 1 year of dividends. They recently started paying out a dividend, so we just don't have the dividend history to look at. You could take a look at their trailing annual dividend yield, 0.75% compared to their current 1.51%. I don't mind doing that if you have more than just a couple years of data, but this one, again, just doesn't have 5 years, even close to 5 years, so we just won't be able to use that. Payout ratio, this is the lowest payout ratio of the group as well, 4.49%, so they are just getting started paying dividends, and they do have a long runway, a lot of room to increase that dividend. Hopefully they do. We'll see. I don't believe we even have data on whether or not they're going to raise the dividend, but I'm assuming they are on this one. Return on invested capital and return on equity. Again, I like 10% or better for these. This tells you how efficiently the company is reinvesting capital back, using capital and reinvesting back into its business model. Return on equity, 36.49%. Very good number. Way over the 10% I'm looking for, almost 4 times. And return on invested capital, 18.75%, almost twice what I'm looking for there. So very good numbers overall. Going down to free cash flow, again, we want growing free cash flow over time. September 2021, going back in time here a little bit, $508 million, 2022 up to $651 million, 2023 slight drop down to $588 million, and again, so far in the trailing 12 months, looks like it may be a little bit more of a decline here, $392 million, though we'll have to see how the rest of the year shakes out. This one is going to be impacted by construction. This company sells electronic equipment, electronics and electronic equipment, electrical equipment, I mean. So this one will be impacted based on how the construction industry is doing, and construction is cyclical as well, just like oil. So whenever the economy gets hit hard, if we enter a recession or something like that, typically construction is one of the first ones to go down and one of the last ones to come back up. My dad was a mason. I am in construction management. That is my field. We are starting to see a slowdown, and really the slowdown we are seeing right now is kind of isolated to certain regions of the country. Some areas of the country doing better than others, and that is the nature of the beast. Now, I will say, if we continue the investments in infrastructure and some of the money that the government is pumping into construction, especially some of the proposals being pushed out there, more home building, that sort of thing, that will help a company like this or any company that deals with the construction industry. We'll have to wait and see how the presidential election shakes out and see if the government's going to, again, help builders out, give them some benefits, I'll call it, whether that's tax benefits or whatever they're going to do there to help promote home building. That would be a boost for a company like this. So going over here, dividend yield theory, again, we don't have the 5 years. Payout ratio very low. Return on invested capital very good. Free cash flow looks good. Repurchase of shares here, we looked at that. Let's jump back over and go to the rest of their metrics. So looking at ATKR revenue, again, you can see here, it looks like they had some nice growth. And again, this is going to be a cyclical company, just like oil and gas. Construction is cyclical, right? As the overall market pulls back, typically construction is the last one to recover and the first one to get impacted. So you'll see some cyclicality around this. And again, depending on what happens in the election coming up, there may be some benefits to construction companies, so maybe this one gets some benefits out of that. But you can see here, 2019 to 2020 looks like a little bit of a drop, but then growth from 2020 to 2022. Now, as the market starts to cool off and construction starts to cool off a little bit, you're seeing a bit of a downturn to 2023. Looks like that's going to continue into 2024 numbers here. Profit margin, same thing. You can see that same cyclicality. Nice run up to 2023. Looks like it drops down a little bit in 2023, trailing 12 months, same thing. Revenue and profit margins should align, so that makes sense. EBITDA, same thing. So you're seeing that run up to 2022, and now it's starting to pull back, right? That makes sense. So you can start to use this, and that's why the stock price is down so much. They are anticipating an impact, but then once you hit the bottom, right, what comes next is that turnaround. That's the next part of the wave, right? So that's how you run these companies that are cyclical. You want to be holding here whenever the price is probably extremely high, and you want to be buying down here whenever the price drops, and then try to ride that back up. Total assets, I do like that their assets are increasing over time. Now we compare that to liabilities, 2.96 billion in total assets. Their liabilities have also increased slightly, though it looks like they might be down a little bit in 2024, but more than enough assets if they had to sell off some assets, 2.96 billion to cover the 1.4 billion in liabilities. Shares outstanding is coming down. We like to see that. They're pulling shares out of the market. Now, the debt has been pretty steady up to 2023. Looks like it did increase a little bit in 2023. Looks like they've taken out a little bit of more debt in 2024. You want to compare this really to cash on hand. I don't have that slide. Maybe I should add that to this one and do the same thing for assets over liabilities. We could do debt over cash on hand, and then maybe move this down a little bit. But overall, their debt is not growing so much that they've gotten out of control with it. I do like that their debt is pretty much remained kind of stable. Dividend yield 1.53%. Annual dividend, we don't need to look at that. Quarterly payout 8.99%. They're saying here from stockanalysis.com. We saw around 4%. Either way, under 10% payout ratio, very low. They do not show dividend growth here. Again, they do not have enough time. They have not raised their dividend yet, so we'll have to wait to see what their first raise is. Buyback yield is 6.8%. Very efficiently buying back shares. They're doing it when they're very cheap. This is a very good number, very high, 6.8%. And same thing with shareholder yield at 8.32%. Overall, as far as an investor, you're getting a very good return on your dollar with ATKR on this one, right? That's part of the reason I think this one looks attractive. Not only that, I believe we're on the bottom of a down cycle now. I think once the election's over, we get into next year, I think things are going to kind of flatten out and start to rebound a little bit. You can see here they do pay 32 cents per share. We'll have to see how that shakes out as far as their dividend growth, though. So that's ATKR. Now over to CVX. So last on our list, certainly not least, is Chevron Corporation, ticker CVS, another one out of the energy sector, another oil and gas company here, very similar to Oxy, though Oxy does do a little bit more in the petrochemical space, where they use some of their products to make, like a LyondellBasell, where they're making some products with it, whereas on Chevron is more of a pure oil and gas play, exploration as well as shipping and transmitting oil as well. So Chevron's a little bit different than Oxy, but they're right in the same sector. Close out the week at $138.56. Looks like they were down a little bit in the after hours. And Chevron is another one that Warren Buffett recently added to his portfolio, though again, if I believe correctly, in his most recent 13F, he was selling off some shares of Chevron. 52-week range, a low of $137.87, as high as $171.70. So again, right up against their 52-week low here. Beta of 1.08, just slightly more volatile than the overall market. Analysts also call this a consensus buy. They have a price target of $182.33, which would represent a 31.59% increase per share on that one. So 31.59 potential upside on this one. Ex-dividend date, August 19th. Looks like they paid out or are going to pay out September 10th, so next week. So you would not be in line for that payout. You'd have to wait a few months if you were to buy this one, next week or the following. EPS sitting at $10.09 per share. Price to earnings ratio $13.74 currently, with a forward PE even lower at $11.06 per share. Nice dividend, $6.52 paid out on the year. We'll see what their payout per share is currently here in a minute. Nice starting dividend yield, highest dividend yield of the four we've looked at today, 4.71%. Jumping over here to look at dividend yield theory, 5-year dividend yield average 4.43%, comparing to its current 4.63%, or over here where it says 4.71%. Either way, both numbers higher than their 5-year average, speaks to undervaluation, at least according to dividend yield theory. Now, payout ratio, this is the highest payout ratio of the bunch here, 62.18%, but still under the 75% payout ratio I like. So they are getting up there in payout ratio, but they still have room to increase this payout over time, continue to pay down debt, make reinvestments back into the company, whether that's acquisitions, whether that's building out, additional drilling sites, whatever they're doing with it. as well as increase their dividend over time, which is what we want. Now, jumping down to return on equity and return on invested capital, see how efficiently this company is utilizing its capital. Again, I like 10% or better for these metrics. Return on equity, 11.76%, above the 10% I like there. Return on invested capital, a little low at 8.49%, but not egregiously so. Again, if we were down to the 1-2%, then I'd be like, oh, this is terrible. But that's pretty close to the 10%. I'd like them to be over 10%, but that's not a showstopper for me right there. Going down to free cash flow, again, we want growing free cash flow over time. Typically, if a company has growing free cash flow, they raise their dividend along with that growth. 2021 here, you can see they were paying they received 21 billion in free cash flow. 2022 up to 37 billion. Big drop in 2023 down to 19.7. And looks like trailing 12 months so far is going to be very similar numbers to what we saw in 2023. Another one repurchasing its shares very aggressively, especially 2022 and on. 2021 was 1.3 billion, 2022 11.2, and even though there was a slight decrease in free cash flow, or a big decrease in free cash flow, they did increase their repurchase of shares. Now that does not offset the decrease, so there is definitely a decrease overall in free cash flow in 2023. And again, very similar numbers so far in the trailing 12 months to what they reported out in 2023. We'll have to see how the rest of 2024 shakes out, but it's going to be very similar. CVX revenue, you can see here, so down year in 2020, growth up to 2022, looks like flattened down, or a little bit of down in 2023 and flattened over the last couple of years. Makes sense. Again, CVX, with it being an oil and gas play, they're going to be impacted by oil prices. Oil prices are down, so if they continue to go down, I believe this one is, so long as oil prices stay around $60 or more per barrel, this one, that's their break-even number, if I remember correctly. I remember reading that somewhere years ago whenever I bought CVX. I don't own them currently, but I did buy them whenever they were down 3 years ago, down significantly, and made a very nice return on this investment along with ExxonMobil. And I believe whenever I read their reports that they were targeting around $60 a barrel. And so long as it remained above $60 or around $60, that's their break-even point to where they're making a little bit of money. Profit margin all over the place here up till you get to about 2021. Looks like a very good year, 2022, 2023, a little bit down in 2024. I'd like to see this profit margin go back up a little bit and start to increase rather than the decrease we've seen over the last couple of years, but still at 9.59%. EBITDA, pretty similar to what we're seeing in profit margin and revenue. Now total assets over liabilities, again, 260.64 billion in total assets, over 100.38 billion in liabilities. So plenty of assets. If they had to sell off some things to cover liabilities, they could more than do that. Shares outstanding, they are slightly, ever so slightly reducing their shares in the system, but it's not a lot, folks. Their debt is coming down. I do like to see that. I love to see a company paying down its debt, though again, you'd want to compare this to cash on hands to see where they're at, but definitely not an issue with debt with this company, and they are not taking on debt currently, where I like to see that. Quarterly payout, dividend ratio 64.65%, again under the 75% we're looking for. Dividend growth on this one is nice, 7.56%, so high single digits there. 37 years of dividends paid out. Buyback yield of 2.73%, shareholder yield of 7.43%. So again, efficiently buying back shares. They're doing it whenever shares are cheap. Shareholder yield is positive. We like to see that. And they do pay out $1.63 per share per quarter. Again, next payout September 10th. You would not be in line even if you were to buy them on Monday for that dividend payout. Well, those are the 4 stocks at or near 52-week lows that might be presenting some value. I think they're worth taking a look at. Now, you want to do more of a deep dive. Make sure they meet the metrics that you set up for yourself. But they look like interesting companies right now, especially with the market pulling back. You want to take a little bit of time and make sure you're looking at these companies. Have some companies on your watch list that you're looking to buy into. Have a price that you want to buy them at, and then be a little patient. As the market pulls back, we're going to find some opportunities here. And if it continues to pull back over the next couple of weeks, typically the market does pull back in September. So we might be in for a good time to be looking at some shares out there, some stocks that we want to buy, putting those price targets together, and be ready with a little bit of dry powder on the backside. When I say dry powder, I'm just talking about funds to invest, money in your bank account, savings account, to be able to put into the market whenever these stocks hit the right price. That's the idea behind these. These are 4 I think are worth taking a look at. 2 of them are in Warren Buffett's portfolio. Doesn't mean you should buy them, but he definitely is smarter than me, probably smarter than you. And if he's taking a look at them and finds some value in them, they might be worth taking a look at. Two other ones I think are interesting right now. Again, Genuine Parts and Atcor. Those are my choices. But let me know what you think looks attractive right now. Drop it in the comments down below. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So again, if you have a stock you'd like me to cover in the Stock Pick of the Day series, drop it down below. I'll work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend, and we will see you in the next one. Don't forget to click that notification bell so you're notified whenever we put out that next video, and the next one will be on Sunday. It will be our portfolio update, so tune into that. See what I bought this week. See what I'm adding to my portfolio. We'll see you in that one. I'm not a financial advisor. This one's got a little long, so you can read the rest of this, but I'm not a financial advisor. I'm not your advisor. Make sure you're doing your own research on these stocks before you buy, and understand that there is the potential to lose money whenever you are investing.